Assalamualaikum and good day to all. Today I will continue a brief discussion related to money and banking under the titles of the meanings of the interest rate. Let's learn about the interest rates that exist in our banking system. Now let us explore what is meant by the interest rates. The interest rate is a proportion of the principals, the amounts borrowed, where the lender will charge to the borrower. The annual percentage rates or APR will be used to describe the interest rates on the loans. And interest rates also can be applied to money earned via a saving accounts or a certificates of deposits at a bank or the credit unions, or we call it CD. The income generated on this deposit account is reversed as the annual percentage yield applied. This means this interest rate will be used for two situations that occur in the banking system, namely the interest rates on loans and the interest rates on saving. Or more easily to understood, we can say interest rates are good and bad. The good is it gives us a returns, while the bad adds our debts in the bank. The interest rates are among the most closely watched variable in the economics. We will use the yield to maturity YTM concepts to measure the interest rates in the banking systems. The amounts of interest rates will be due every period, or we known as called the principal sums. It will express as a percentage of the amount lends, deposited or borrowed. The total interest paid on a loan is determined by the principal amount, the interest rate, the compounding frequency, and the length of time it is lent, deposited or borrowed. What is annual percentage rates or APR? Refer to the yearly interest generated by a sum that's charged to the borrower or paid to investor, or we call it the saver, expressed as a percentage that represents the actual yearly cost of funds over the terms of loans or income earned on an investment. This includes any fees or additional costs associated with the transactions, but we have to bear in mind this APR does not take compounding into account. APR also provide consumer with a bottom line number they can compare among lenders, credit cards and investment product. What is annual percentage yield or APY? APY is the real rates of returns on an investment after compounding interest is taken into account. Compounding interest is unlike simple interest. Is calculated on a regular basis and the amount is immediately added to the balance. As the account balance grows larger with each passing period, the amount of interest paid on the balance grows as well. This means that APY is more to the gains of interest as a result of investment or saving needs, which as a result of the investments, the consumer will receive additional funds at the end of the investment year. The APR versus APY. Consumer loan interest rates are usually expressed as an annual percentage rate, APR. The lenders, or we can call it the bank, expect these rates of returns in exchange for the ability to borrow money. Credit card interest rate, for example, are expressed as an annual percentage rate, APR. The APR for the mortgage and borrower in our case above is 4%. Compound interest rate for the year is not taken into account by the APR. The annual percentage yield APY is the interest rate earned on savings accounts or CD at a banks or credit unions. Compounding is factored into the interest rates. Here it is more clearly since the APR is more to the interest charged on loans, while APY is more to the interest given on investments or savings. Now let's understand more about the interest rates. The first one is interest is a fee levied on a borrower for the use of an asset. Cash, consumer item, vehicles, and real estate are examples of assets that can be borrowed. The second one is the interest rates on a loans is applied to the principal, which is amount borrowed. The interest rate is the borrower's cost of debt as well as the lender rates of return, because lender seeks compensations of the loss of use of the money during the loan time. The amounts to be repaid is frequently greater than the amount borrowed. Instead of renting a loan, the lender may have invested the funds over that time period, generating income from the assets. The interest charge is the difference between the total repayments amounts and the original loan amount. The third one is the majority of loans and borrowing transactions are subject to interest rates. Individual take out loans to buy houses, fund projects, start or expand enterprises, or pay for the college tuitions. Businesses borrow money to fund capital projects and expand the business by buying fixed and long-term assets like lands, buildings, and machinery. Borrowed funds are repaid in full on a predetermined date or in monthly payments. And the last one, when a lender considers a borrower to be a low risk, the lender will normally charge a lower interest rate. If the borrower is deemed high risk, the interest rate paid to them will be higher, resulting in a more expensive loans. The important thing that we have to bear in mind, a lender's risk is often analyzed when a potential borrower's credit score is examined, which is why it's critical to have a high credit score if you want to qualify the best loan. This means before the loan is given, the lenders or bank will obtain information and documents from the borrower to assess the levels of eligibility. If they are really eligible to borrow, then the loan will be approved. This is also to prevent the asymmetric information occurs. We have learned about asymmetric information in the previous topic. You can refer to it in the videos and flipbook that have been provided. Now look at the examples of the simple fixed interest rate calculations. If you take out the 300,000 mortgage with a 4% interest rate, you will have to pay the bank the original loans amounts of 300,000 plus the 4% times 300,000 interest rates to the banks. So it equivalent to the 312,000 that you have to pay to the bank. This is just a simple examples of calculating the interest rate using the APR method for loans for a period of 1 year only. For that reason, the borrower only has to pay only 12,000 to the bank if the loan is 300,000 with an interest rate of 4% per annum. Now look at the interest rate in simple terms. The following example was calculated using the yearly simple interest formula. As I mentioned earlier, if the loan was only for 1 year, the persons who took it out will owe 12,000 in interest rate at the end of the year. But what will happen if the loan was 30 years? The interest rate payment would be as follows. We will use this formula, which is the principals times the interest rate times the times. So the calculation will be 300,000 times 4% times 30 years. So it will equivalent to 360,000 that the consumer have to pay to the bank. An annual interest rate of 4% equates to a payment of 12,000 in interest per year. The borrower would have paid 12,000 times 30 years, so it equivalent to 360,000 in interest payment after 30 years, which is how banks generate money. Now let me look how our interest rate determines. As we know that interest rates are governed by a variety of factors, including the status of the economy. The central banks of a country, for the case of Malaysia, we call it Bank Negara, set the interest rates. Bank uses to establish the APR range they provide. The cost of debt rises when the central bank set interest rates at a high level. When debt costs are high, people are less likely to borrow, which lowers consumer demands. The interest rate also tend to climb in tandem with inflations. How to prevent inflations? The bank will impose higher reserve requirements, which is the bank will tighten the money supply by reducing the money supply in the markets, and the bank also will increase the credit demands, which bank will encourage people to borrow more. But what will happen if the economy facing the high interest rates? So people will prefer to save their money since the saving rates is higher, and the stock market suffer because investors would rather save and earn a greater rates than invest in the stock market, which pay a lower rates, and the business also have limited access to debt capitals, resulting in economic contractions. This situation occurs when the economy is in high interest rates. What will happen if the economy face the low interest rates in the economy? If because of the low interest rate occurs in the economy, so the borrower have access to low interest loans, economies are generally spurred during periods of low interest rates. Because saving rates are low, firms and individuals are more likely to spend and invest in riskier assets such as stocks. This expenditure stimulates the economy and inject funds into the capital market, which is good to the economies because it will resulting in economic growth. While government favor lower interest rates, they eventually leads to market disequilibrium in which demand outstrips supply. It will result in inflations. Interest rate rise when inflation occur, which may be related to the Walras law. You can refer to the Walras law in the flipbooks that has been provided.